Hey everyone, and welcome to this explainer. If you've been watching the market at all lately, you know it is just completely wild out there. So today, we're doing a reality check. We're going to cut through all the breathless hype and the crazy jargon surrounding the mid-2026 AI market, and we're basing this entirely on some incredible, fresh reporting over at Miquio. Because look, when you see a stock like SanDisk up roughly 857% this year, you kind of have to stop in your tracks, right? It literally forces the ultimate question. Are we sitting inside a massive, delicate AI bubble, or is this incredible boom truly just getting started? Okay, so here's our roadmap for today. We're gonna do a quick AI reality check, break down the 3 risk buckets, compare real revenue versus hype, uncover some hidden risks like circular financing, tackle the great bubble debate, and finally, talk about how to actually invest. Let's get into it. Section 1, the AI reality check, sorting booked revenue from promises. Look, here in 2026, simply dropping the letters AI on a quarterly earnings call, that just doesn't work anymore. The real divide in today's market is actually pretty stark. On one side, you have companies that are earning hard, recurring AI cash right now. And on the other, you've got valuations built entirely on a promise. Businesses that are still just selling a story about future adoption. Figuring out which side a company is actually on is absolutely crucial. Section 2. The 3 risk buckets. The bucket tells you the bet. I want you to think back to the 1849 gold rush for a second. The folks who reliably got rich, they weren't the ones out there digging for gold. They were the ones selling the shovels. And in 2026, we can use that exact same logic to drop AI stocks into 3 distinct risk buckets. First up, you've got the picks and shovels. Think Nvidia, TSMC, SanDisk. They get paid first, no matter whose chatbot ultimately wins. Next, you have the cloud platforms like Microsoft and Alphabet. They rent out the massive compute power and just have these fortress-like balance sheets. And finally, the speculative pure plays. These are single-purpose software companies that offer, massive upside, but they're essentially lottery tickets. Section 3, real revenue versus hype. Who actually earns AI money? All right, let's shift gears and look at the actual numbers because this is where it gets crazy. $75.2 billion. Just let that sink in for a second. That is what Nvidia booked in data center revenue in just one single quarter. We're not talking about some 5-year forecast here. This is money walking in the door right now. It proves the infrastructure layer is just generating unprecedented amounts of cash. And we're seeing this momentum building across all the hardware and cloud giants. Microsoft just crossed a $37 billion AI annualized run rate. Alphabet, their Google Cloud Gen AI products are up nearly 800% year over year. And Broadcom is seeing its AI semiconductor revenue jump 143%. The big takeaway here is that these giants are actually successfully converting all this AI demand into recurring contracted revenue. But of course, you also have these massive surprises, like SanDisk surging roughly 857% year to date. This explosive growth is totally driven by an AI-fueled NAND memory shortage. But, and this is a big but, here's the warning label. SanDisk is a very real, very solid business, sure. But entering at this price point is super risky because memory is a notoriously cyclical industry. Cycles always end, so a stock jumping over 8-fold in 6 months, it's basically pricing in a shortage that lasts forever, which just doesn't happen. And when you place the myth right next to the reality, the contrast is pretty jarring. Microsoft is soaring with literally tens of billions in booked AI revenue. But then you look at C3.ai, this is a speculative, pure play with AI literally in its name, yet their revenue actually fell 52% in its latest year. It's the exact same AI label, but a completely opposite financial reality. Honestly, even on the infrastructure side, you really have to be careful about valuation completely outrunning reality. Take Astera Labs, for instance. They trade at around 264 times earnings. Now, to be clear, they are not frauds, not at all. They make incredible connectivity chips. But at a 264 multiple, they are priced for an absolutely flawless future. There is literally zero margin for error if even one big buyer decides to pull back. Section 4, hidden risks and circular financing. The risks top 10 lists skip. Because behind all those cheerful top 10 stock listicles, there are some very real systemic dangers lurking. Namely, massive concentration risk. Get this, just 10 stocks drove roughly 83% of the S&P 500's gains. Think about what that actually means for a second. If there is a stumble in just a handful of these top names, it doesn't just hit the tech sector, it hits almost every single broad index fund on the planet. And layered right on top of that concentration is this totally fascinating market dynamic called circular financing. This happens when the massive demand that's propping up AI revenue is actually being financed by the exact same companies selling the product. It's kind of like the tech ecosystem paying its own allowance. Let me walk you through exactly how this works step by step. Step 1. Nvidia invests billions of dollars into OpenAI. Step 2. OpenAI turns right around and uses that money to buy Nvidia chips. Step 3. Giants like Oracle and Microsoft host OpenAI, funding them while simultaneously booking OpenAI's massive compute spend right back as their own cloud revenue. Now, none of this is illegal, but it definitely means that a chunk of this incredible customer demand we keep hearing about is really just the tech ecosystem passing the same money back and forth.
Section 5. The Great Bubble Debate. Both sides have a case.
Right now, there is a really fierce disagreement among world-class financial experts about whether this is just a massive bubble waiting to pop. On the bear side, you have some serious heavy hitters sounding the alarm. Michael Burry, the guy who famously called the 2008 housing crash, he explicitly stated that May 2026 is feeling like the last months of the 1999-2000 bubble. And he's not alone. Legends like Jeremy Grantham and Paul Tudor Jones look at the concentration, they look at the multiples, and they see a classic textbook bubble. But the bulls have an incredibly strong counterargument too, championed by institutions like Morgan Stanley. They are calling these fears totally premature, and they point out a really critical difference. Unlike the year 2000, today's tech giants are not profitless .coms. They are generating enormous real cash flow right now. On top of that, the median large company today is sitting on 3 times the cash cushion they had during past bubble peaks. So the bulls argue that, yeah, the prices are incredible, but they are justified by incredible tangible earnings. It's a debate where honest people disagree, and both sides have very compelling cases.
Section 6. How to actually invest. Pick a risk you can live with.
Now, before we dive into this part, a quick reminder that this explainer is strictly journalism, okay? Not financial advice. But for beginners trying to enter this wild market, it really comes down to trade-offs. Buying single stocks gives you super focused exposure, sure, but you carry the full heavy weight of a company having just one bad quarter. Alternatively, AI ETFs offer a much calmer entry point. For a really small yearly fee, you're spreading your risk across dozens of names, which kind of smooths out the turbulence.
If you are looking at that ETF route, there are several solid options depending on where you're watching from. In the US, you've got AIQ, RAT, and QTUM. Up in Canada on the TSX, there's TEC, and down in Australia on the ASX, you have GXAI and RBTZ. Oh, and a super quick practical tip for international investors: filing a simple W-8BEN form with your broker can actually cut your U.S. withholding tax on dividends from 30% all the way down to 15%. Definitely worth looking into.
Ultimately, the biggest takeaway from all of this is that in 2026, investing in AI stocks and investing in the broad market have become nearly the exact same bet. So the real question isn't just what you should buy, but rather, which risk can you live with? I highly encourage you to read the full in-depth source article over at mikuyo.com so you can dive even deeper into these numbers. Thanks so much for joining me on this explainer, and keep learning.